Hello and welcome to this latest business leader panel debate. We've got a really good one for you today. It's called Preparing for Tomorrow's World, and we'll be talking to some consumer brands about how they're seeing the funding landscape change. We've got some really good guests. We're going to run for about 45 minutes, and there is an opportunity to send in questions if you, the viewers, have any. The aim of this debate is to look at the consumer retail space and how these brands are kind of faring currently and how they are funding their growth ambitions. We are Business Leader. For those that don't know, we run lots of these events as well as some major awards, and we publish a print magazine. Do go check us out at www.businessleader.co.uk. Our partners for today's event are Growth Lending, so big shout out to those, and do go check out them and how they can help you on your business journey. So on to today's debate. On the panel, we have Julian Hornby, who is a principal at Growth Lending. Julian's going to give us some insight into how they are seeing the market at the moment. We also have Dominika Minarovic, who is the co-founder of BYBI Beauty. Good morning, Dominika. We also have Tom March, who's the founder and managing partner at Redrice Ventures. And last but not least, we have Alex Wright, the founder of Dash Water. So welcome, everyone. What we'll do, we'll get straight into the debate, and we're going to look at raising debt and how that is supporting companies. Alex and Dominika, sorry, just wanted to kind of start with you both. Maybe if Alex, you kind of take this one first. You've obviously both raised various debt facilities in the last few years, as well as various equity rounds. There are many younger founders who might assume they must simply rely on equity to kind of charge their growth in the early years. And we all see programs like Dragon's Den that kind of feeds into that narrative. But just want to get an insight from you into what are some of the key benefits of using debt and what that's enabled you to do, Alex.
Thanks, Ollie, and thanks, Julian, for having me on this morning. For anyone that hasn't heard of Dash, Dash is flavoured sparkling water infused with wonky fruit and veg that's retailed in about 7,000 stores and online as well. To answer your question, giving away equity is very hard to get back. And so the second point is also that the value of your equity today may be considerably more valuable further in the future. So the longer you can delay giving away your equity for equity rounds, that will mean that it'll be more valuable in the future. I think the key benefit for us working with debt financiers like Growth Lending is that it's enabled us to enhance our working capital cycle. Especially in the early days of Dash, we had to pay pro forma for much of our raw materials, and some of our customers, not naming any names, hold some early stage brands to ransom, demanding up to 90-day payment terms. So that working capital cycle can be relatively unfavorable for a soft drink business like us. And Growth Lending has enabled us to scale our business much faster and ensure we are able to take advantage of new opportunities, especially in retail, both in the UK and abroad, whilst enhancing our working capital cycle.
Alex, that's really interesting, and that kind of scaling piece there that you talk about, and how debt allowed you to kind of do that very quickly, whilst obviously not giving away equity in your business. Dominika, is there anything you wanted to add to that? And if you could answer that question, please.
Yeah, absolutely. I think we've always tried to supplement an equity round with debt as well. And we find that those two work quite well hand in hand, because as a kind of unprofitable early stage startup, raising debt or unsecured finance is really challenging. Particularly, you don't tend to have many assets to lend against. For us, it's really just our receivables. So raising debt is just generally really challenging. So what we try and do is just maximize any equity rounds that we do, and then use that as leverage to get some good debt. We've done that a few times when we've raised our seed and Series A, and that's always been quite fruitful for us as a way to kind of top up an equity round and obviously not give away as much, because giving away equity in your business, particularly at early stage, can be really impactful for your own stakeholding within the business. But venture is typically the route that a lot of brands or consumer, even tech go down, because raising debt in the early stages is so challenging. And I think it would be great to see the landscape slightly change around that, because a lot of founders end up in difficult situations further down the line, because they've given away kind of 20, 30, 40% of their business before they've even got off the ground. And that can be quite demoralizing as a founder as well, because then when you go at later stage to do kind of big rounds, then when you genuinely have a business that can justify and needs supporting in that way, you can end up with absolutely nothing. And equity is obviously the main motivation for driving founders. So I think that has been quite an interesting tactic for us. Obviously, similar to the Dash, the early kind of getting off the ground is hugely capital intensive as a consumer brand, because you're having to buy stock, and a lot of the manufacturers work to minimum order quantities, and pro forma is a common thing when you've got no trading history. So those early stages are really, really difficult to when you don't have a good financial backing. But even as you scale, working capital continues for us as a business that's 5 years old and multi-million-pound business, is just the absolute bane of my life. Working capital is so tight all the time, because we work with retailers that pay us in longer cycles than we have to pay our suppliers. So then there's always a crunch point. So debt in that instance becomes hugely important. But as I said, raising it alongside an equity round has been quite a successful strategy for us.
Thanks, Dominika. Julian, it's interesting that Dominika mentioned that in the early stages, obviously companies often, traditionally give away a lot of equity, which can, have big impacts later on when they have probably had much more product market fit. And Dominika mentioned some of the barriers there to kind of raising debt. I mean, do you have any insight there? And is action being taken, or is it just a kind of communication thing for companies?
Yeah, I think to build on what Alex and Dominika have said, so the key thing in raising debt is what is the collateral that the borrower can use to leverage against and raise cash against. Collateral in simple language is as simple as the debtor book. So what are the B2B, what are the sort of supermarket assets that we can lend against? What's the inventory? What's the plant machinery? And for businesses that haven't built up necessarily a sort of significant track record, there isn't a huge amount of an asset base to lend against. So before you build up that track record, there aren't just as many options available for earlier stage brands. I think on a slightly different point, but a second barrier could be the notion of personal guarantees. With traditional business loans that you might be able to obtain from your bank, 95% of the time for early stage businesses, they'll need a personal guarantee, which is obviously a very kind of personal decision for business owners, for founders to be making. So that's definitely a barrier and possibly sways individuals in going towards equity in their early stages. I think all in all, for very early stage brands, equity is can be much more appealing. And as they scale, they become more appealing. Businesses become much more appealing to debt finances, and in turn, they obviously have more options available to them.
Thanks, Julian. Some good insight there. Tom, welcome to the debate. You've just got want to kind of run a scenario by you, Tom, and get your insight into this. If you're kind of being pitched by a startup who's previously raised debt and has debt on the balance sheet currently, what does this show you, and how does this affect your decision-making process when you're engaging with that company?
Yeah, thanks for having us on, by the way. So look, we're big supporters of companies using debt where they can. I think how we look upon it depends on a lot of factors. So I think as a starting point, most companies that we back, as Dominika alluded to, are early stage. They're seed Series A, so therefore they're loss making. They're still very much in growth phase. So we need to get comfortable that that they've got levels of debt in the business that are serviceable, and that the strategy kind of ongoing post investment is going to maintain that philosophy. We do like to see companies use debt, as I said, as part of the funding mix, and if the terms are right for them. I think everyone's already given examples of how you can use debt to benefit everyone involved in the business around working capital, buying inventory. So if you can finance that efficiently with debt alongside equity, actually that equity can be used in a different way to really grow the business, to invest in growth, to invest in innovation, which again helps everyone. So from our perspective, it's just about founders using it sensibly.
Tom, again, some interesting insight there. And we're now going to kind of just cover equity in a bit more detail. And Dominika, I want to start with you. You mentioned you often kind of raise debt alongside equity. So interested to get your kind of take on this. And you've recently you had a considerable Series A raise, including some well-known venture funds like Unilever Ventures. I think it'd be really interesting for our viewers to kind of get an insight into your experience in raising money from VCs, and any kind of pros and cons that you can kind of go through.
Yeah, well, seeing as we have a VC on the call, I better be diplomatic. No, like venture funding is hugely beneficial, and I think something that you don't get with debt providers is that network and that experience of those investors. So Unilever Ventures is one of our VCs on our cap table, and their whole portfolio is centered around brands that are trying to achieve the same thing as us. So the cross learnings that we receive from, our investment director there, and the support that we receive from him and the insights are invaluable. And we wouldn't necessarily get that from our debt partner because they're much more transactional and less focused on the nuances of the business. And I think what Tom said about what you would use those separate pots of money for is really interesting, because I think we've definitely been guilty of using our equity financing for working capital, which is so expensive. If you do the math on it, it's a hugely inefficient way of raising capital for the business. And actually any venture or equity money that comes into the business should really be used for growth and not working capital, because even the most expensive loan that you could get, 30% interest or whatever, is actually more cost effective than using venture money for working capital. So I think being really clear about what you want to use that money for is hugely important. But I think for us, we've done 2 fundraisers. So we did a seed and a Series A, which you mentioned. So that was in December 2020, we closed that, and that was $7 million. And I think, like, as a consumer brand, particularly in personal care, which is where my brand is, raising venture capital in order to facilitate steep growth is needed. It's very difficult to scale a beauty brand without significant backing. So we knew from the first ideation of the business that we were going to go down the venture path, which meant that we created the business in a certain way. It was very trend focused. It was very VC friendly in terms of our growth ambitions and our exit strategy, and the way that we wanted to scale the brand and the kind of retail that we wanted to work with. So we kind of set up the business to be high growth and very VC friendly, as I said. But VCs, I would say, over debt, although I'm seeing a shift as we speak to more debt partners, is VCs are very focused on the team and founders. They really buy into the vision and the people running the business, whereas debt providers really look at the balance sheet and look at the fundamental economics of the business and don't tend to like loss-making businesses, whereas VCs are more open to those, given the growth that a lot of businesses are trying to achieve. So they're just very different conversations, and I think equity is much more about the vision, the founders, where you want to get to, and then debt is about providing assurances that you are running a business that, as Tom mentioned, is in a position to repay and manage and be sustainable around any debt taken on. So it's like responsible lending versus like ambition and vision, and they're very 2 different conversations. If I went into a debt conversation trying to sell my VC vision, I don't think it would land quite well. I'm pretty sure I've tried to do a job on Julian in the past, but it probably hasn't landed quite in the right way as it would with a Tom, for example. So they're just very different pitches, very different conversations that you would have.
No, thanks, Dominika. And I think you were suitably nice to our VC representative there in that answer, and we'll come on to Tom in a bit. But Alex, I just want to kind of speak to you now. It's quite interesting looking at your kind of funding journey, and you've raised the majority of your equity capital from an impressive array of angel investors and industry veterans. And they include the footballer Patrice Evra, who I'm sure lots of people will be familiar with. And just want to get your insight into what have been the kind of pros and cons of raising funding from high-profile people like that.
Yeah, it's very amicable between each other on this panel talk. I like it. We have raised a number of investment rounds over the years. In total, we've raised about £6.5 million, both from angel investors, but also institutional funds. I think that the key for us is not going for high-profile names for high-profile name's sake. We just ask one question with our investors after we get to know them very well, which is, how are you going to add value to our business? And so if I list a few of our investors that we've had so far, the founders of Sipsmith Gin, the premium gin brand, Bulldog Skincare, Beavertown Brewery's founder, the guys who started Diageo's incubator, a director of Fiji Water. And these people that you look to get on board can have the same downside, whether they're an institution or an angel, that can be things like being too demanding, not being aligned with your vision, can cause friction with other shareholders, and overall it can be a massive disruption to the day-to-day running of your business. So getting it right is really key. On the other hand, the pro side of getting really good investors means that they can significantly add value at the right stage of your business. So, for example, at the moment, we have put together our summer marketing campaign, and we've got a big above-the-line campaign that we are doing in order to increase brand awareness. One of our investors, he was the old marketing director at Innocent, and he's been amazing at supporting us, sharing his learnings to put together this summer marketing plan. So I think there are major upsides. That said, a lot of investors can promise the world, and it's essential just to make sure that you do dig into the detail, especially the time that investors can give you. And if that needs to be written down, then it's well worth doing so.
Thanks, Alex. Some good advice there to end on, about kind of doing your homework there and making sure you're getting a good deal. And Tom, just want to bring you in again and just get your opinion on equity investment on the whole. Is becoming a lot more accessible to early stage brands. Would you agree with that?
Yeah, definitely. I think if I think back kind of 10 years, crowdfunding wasn't as well progressed at that point. So I think there are options through that, definitely, particularly for brands, because they can crowdfunders can resonate with and understand the products. I think the ecosystem within this sort of angel community that both Dominika and Alex have touched on is more progressed as well. So there are people out there who are part of really successful brands, household brands that have had exits themselves or kind of grown their passion for brands, who are willing to help. And I would say, approach those people on LinkedIn, because they will be interested in your business. What I still think there is the ecosystem is lacking is sophisticated consumer VCs. I think the guys have touched on the lack of operational expertise, entrepreneurial expertise across the VC ecosystem within consumer. I think a lot of VCs are specializing in sexier themes, tech-orientated themes that their investors want to get access to. So I think we've got a long way still to catch up with, say, the US to getting a decent number of consumer-focused funds out there. But it's definitely better than it was.
Thanks, Tom and Julian. If you're analysing a startup who's previously raised equity from reputable sources, what does this show you, and how does this affect your kind of decision-making process?
I suppose, in short, it's a positive thing for us. for two reasons. The first one being liquidity-wise, the equity provider, whether that's an angel or a VC, are chucking more cash into the business. We often talk about sort of lengthening the runway in the debt finance world. As Dom alluded to, so traditional debt financiers don't love supporting loss-making businesses. And I think we possibly are at the sort of forefront of this, but the way we view a loss-making business is that if we can sit alongside an equity provider and we can gain confidence from the equity provider that actually they've got ambition to reinvest at the next raise, and we often have sort of off the record conversations to gauge their appetite for future investment raises. That gives us confidence that we're not simply sort of chucking money at something that's running itself into the ground, and actually we're bridging a gap. We're sort of lengthening that runway for the brands. And I suppose secondly, just from an analysis perspective, it helps us sort of justify that we've done our homework and that we are our judgment that there's a strong management team, a strong product, strong sort of market fit is justified in that sense.
Okay, thanks, Julian. And I just want to continue on the kind of debt and equity theme, but look at the kind of cost of those kind of funding levers. And Tom, I mean, you often hear people say the expression that equity is the most expensive form of capital. Can you explain to listeners who maybe haven't raised or aren't as experienced at kind of raising, just saying what this means and when are the right and wrong times to look at raising equity?
Yeah, so Alex touched on it actually in his intro. But so raising equity involves basically parting ownership with some of your business. So you're diluting your position. So if you assume that your business is successful in the future, there's huge potential upside in that equity value. But if you've just reduced your participation in it, that can be costly to you as a founder. So whereas with debt, you've got the cost is driven by the interest payments, by the capital you have to pay back at some point in time, and in most cases that cost is capped to you. You know what it is from the outset, so you're effectively potentially losing less money or less value in the future. So I think that's just sort of speaks to the point that if you have the ability to get debt into the business in a sensible way, absolutely do it, 100%.
Thanks, Tom and Dominika. Tom just mentioned, the kind of cost of giving away kind of shares in your company, and just want to kind of focus on the sort of costs of bringing on debt. And I mean, beyond the kind of direct interest costs, obviously you will incur if you engage with the debt financier, such as kind of growth lending, and the kind of dilution effects of that, which Tom has just outlined when you're talking about equity. Are there any other hidden costs, of whether that is equity or debt, that you may incur as a business?
Well, I think around venture and to a certain extent debt, there is the legal costs associated with it, which is often kind of not factored in, particularly if you haven't done either before. So a fundraise with drafting a shareholders agreement can cost £20,000 to £30,000, and often you have to cover at least a proportion of your partner's legal costs as well, which can be a little bit frustrating because you're also it's an equity exchange, so you can always work back to figuring out how much that costs you, and it can be quite a lot. So I think that there is a big cost associated, particularly with equity financing, which is often forgotten about when you think about, I'm just getting money into the business, it's a straight transaction, I don't have to fork out any cash. You do, and it can be quite substantial. And then with debt as well, when we recently did quite a big debt deal, and that was almost a similar, it felt very similar. Like I got a term sheet and I had to run that through our lawyers, and there was, paperwork. And so when you get to bigger debt deals, there can also be a legal cost associated with it. But I think the hidden costs of doing an equity round are definitely the legal side, is what I would say. And if you take on additionally like a non-executive director onto the board, which if you do an institutional round of a certain size, that is a kind of expected part of the transaction, you often have to pay a director's fee as well. So that can be 10 to 15 to 20k a year that you're paying out to your director. So if you think about that as a cost on top of giving away equity versus what you then pay for debt, it can really stack up.
Thanks, Dominika. Really interesting. Alex, obviously, time is money, especially when you're in business. Dominika mentioned there some of the hidden costs, and it seems there's a lot of process, isn't there? Can you just give your kind of insight into how you found that and the kind of indirect costs that you occur, including kind of your time and your team's time?
Of course. So maybe starting on the debt financing first. I think the one of the things to watch out is just making sure that you have looked into how the hierarchy of debt is structured within your business. So, for example, you might have existing debt that might not want to be subordinate to any other debt financing that comes in. So it's just worth having a look in advance and making sure from a legal perspective that's all going to be fine, because it can cause headaches if spotted further down the line. Regarding equity, as Dominika quite rightly says, time consumed raising investment is pretty hefty. So both from the preparation of investment docs, preparing of financial info for the data room, and answering due diligence questions, it's a full-time job raising investment, and that can come to the detriment of your business. I suppose other costs for equity raising can also be from the restructuring of your shareholders agreement and articles of association as well. So the restructuring of the shareholders agreement can mean that it will you can considerably decrease the amount of control that a founder has in the business by giving it over to new investors. And therefore, it's just worth making sure in advance that you've got really good solicitors that are advising you from the offset.
Thanks, Alex. That's really good to hear. We've just momentarily lost Julian, but we will have him back. He's just refreshing his browser. So what we'll do, we'll move on to our next topic, which is really important. It's about kind of diversity when kind of raising equity or bringing on debt. And Dominika, just want to get your insight in how did you find raising debt and equity, being one of two female founders, given the statistics, which we are often quite rightly reminded of, that the odds are stacked against female founders. How did you kind of find that process? And second question is, do you feel that there is a shift happening?
We're often reminded of the kind of stat, which is, I think it's less than 3% of all venture capital funds raised go to female founders, which is an appalling stat. And I think actually has declined. So I think there was a slight increase in 2020 and then has gone down for 2021. And I think, it plays into a lot of the challenges women have around running businesses and their preconceptions and placed upon us. But I think we've been successful because we have always been incredibly confident and clear about our vision. And I think that there's potentially a lack of confidence around female founders when they go to market. And I think you have to have confidence walking into that room and not be burdened by some of the, I guess, like the tales of the market. I think some of the instances that we've had, I have raised money in a very attractive area of personal care, which is beauty, which has been at the forefront of many VCs. And obviously a lot of beauty is founded by females. So I would say within the venture capital portfolios that I sit, there are a lot of female founders. And I think it's never felt like a stigma associated with that. And, all of our venture partners are hugely supportive of not only female, but, diverse founders across the board. And I think that is super important when you're looking at who you're potentially partnering with. But we've definitely, in beauty, we've definitely had the oh, thanks, I'll give this to my wife to try. And I think comments like that can just be very, it can undermine the power and the business potential of a product when it's kind of discarded and kind of passed on to someone else. And I think that has happened to us quite a lot. And I think, men don't always understand beauty, although it's very actually easy to understand because the margins are great and it can be hugely profitable and great exit potential. So it's not that difficult to understand. But I think, I think when you get to personal care investors, they're much more open, and I feel like there's more stigma around some other industries like tech, but it's no doubt been challenging. And we often sit in a room, a boardroom full of men, but you can't let that phase you. You just have to crack on. So that doesn't really answer your question. I wouldn't say that I've been subject to a huge amount of discrimination, so I probably come at it from a more positive perception, but the numbers are the numbers, and I think that there definitely needs to be a change in perception, because women make great leaders and they make great decisions, and they can certainly run high growth venture capital backed businesses. So
yeah, no, it definitely did answer the question, Dominic. And that's your experience, and it's, I think, going to be valuable for our viewers. I mean, if you were just to kind of like really encapsulate just one piece of advice, I know that's difficult, but just one piece of advice to kind of a female founder who might be watching, who's going to raise, what would that be?
Yeah, and something I would also add is that I closed a $7 million fundraise in the middle of a pandemic while I was 8 months pregnant, and my co-founder was 6 months pregnant. So again, like, it's all about knowing your numbers, knowing your vision, being really clear and confident about where the brand is going, and don't let stereotypes or preconceptions get in the way of you delivering that to your potential partner. Confidence is key, and just being, knowing your numbers, I think is a big thing as well, because when you can confidently articulate the business potential, if someone doesn't necessarily understand your product, they certainly will understand the numbers. So I think as a supplement to being, articulate on your vision, I think knowing your numbers is hugely important when you have those initial pitches as well.
No, thanks, Dominika. Some good advice there. And Tom, as a funder, obviously on the flip side now, you will see lots of pitch decks, lots of companies. I mean, is there anything you feel that you could kind of, not just you personally, but your sector can do differently to kind of increase more diversity in your portfolios?
Yeah, I think those stats, 3% is astounding. I think we're doing okay as a business. I think we can always do better. So about a third of our portfolio founders are women. I think investing in the consumer space across lots of different categories, we would expect that to be higher. We hope it will be higher. I think women, power the majority of consumption decisions in a household. So it should obviously be higher from a practical perspective. I think in terms of us, we're doing a lot of things. We're working with an organisation called Change UK, Change 2020, who help underrepresented professionals with the development program, and we do entrepreneurship sessions with them, workshops. We've also tried to, and I think this is fundamental actually for VCs, but I think we've been building out our team. And it's not just about building out the team and having greater diversification there or diversity there. It's also about empowering people and making them part of really these important decisions. And also around us, we're fortunate enough to have a really good network of diverse operators and consumer sector founders who've had success, who provide insight into our due diligence process. So again, all of this kind of filters through to us making better decisions, I think. But the stats are sad, and I think there's a huge amount more that needs to be done.
No, thanks, Tom. I think there is a perception, isn't there, that VC seems to be a bit better than some of the other kind of funders as well at having a more kind of diverse portfolio, but obviously lots more to do. Julian, even though we can't see you, we can still hear you. So you've come back at the right time. I'm just going to see if you can comment on the sort of diversity subject and how kind of growth lending are trying to act to bring on people from more underrepresented backgrounds.
Yeah, sorry, well, we seem to be having some tech problems. Can you hear me all good? Perfect. So yeah, I think it's a tricky one, because the way I look at it as a funder, the sort of mentality you have to have is that you can always be doing more. I think internally, as Tom sort of touched on, so growth lending as an organization, we have a fantastically diverse sort of workforce, etc. And the key challenge for us now is translating that into our portfolio. I think historically it's been easy to sort of sit back and say, well, we're simply not seeing enough applications and sort of leads from female founders or founders from different ethnic backgrounds. But what we're realizing more and more is to be kind of proactive. We've hired regional directors to sort of go around the country, serve perhaps the more underserved areas of the UK, and kind of building relationships as best we can with various business networks. A great example of in the consumer or FMCG world, there's a not-for-profit accelerator called AdSalt, who are doing amazing things, helping Black-owned brands scale in the FMCG space. So I think the overall message is to kind of push oneself to be as reactive as opposed to proactive as opposed to reactive. And that's where you really begin to see the change.
Julian and Alex, just on this subject, I mean, when you look at the UK FMCG industry, do you feel it's doing enough to support underrepresented founders?
I don't think there is enough support. No. I thought it was really interesting what Tom was saying about supporting Change 2020. I think that's a really, really good thing to get involved with from an earlier stage in entrepreneurs' working lives. I think the industry in general, the number of Black people receiving funding is around 3 to 4%. So that statistic is still pretty shocking. We're obviously very conscious of for making sure on our team that we are being, as Julian said, super proactive. We operate the Rooney Rule when we interview candidates for new rules. So that means that we have to have minimum one person from an underrepresented background. And perhaps this could be something that funders look to operate as well when they're looking at their investment decisions for the year. Maybe that could be something that could be a process that would mean that there would be more underrepresented people that would come through the door and get airtime with investors.
No, thanks, Alex. I think that would be a good thing to implement. So it'd be interesting to kind of see how that progresses going forward. Just want to now change tack to our kind of penultimate kind of topic point, which is the changing kind of funding spectrum. And Julian, we'll just start with you on this, and just want to get your insight into what changes do you foresee in the debt ecosystem in the coming kind of 12 to 24 months?
Yeah, so I think the kind of obvious point is that, and we're reading about it in the front page of our newspaper every day, is that interest rates are rising. And sadly, the government are doing that to deal with inflation, and that is passed on to the borrower. Lenders will often talk about lending at 4% over base or 5% over base, and that base rate, the Bank of England rate, is becoming more significant. So having been sort of 0.25, it's rising to 1. It could be 2 or 3% in the coming year or so. So yeah, I think from a headline perspective, the cost of debt is increasing and the cost of borrowing is increasing. And I think in terms of sort of positive changes from an innovation perspective, the two key things are what kind of technology and what new products can debt financiers bring out in order to support the changing needs of businesses. From a technology perspective, the way we look at it is that it has to be customer focused. So everything has to come from what's the customer looking for. Typically in debt, it's a sort of trade-off between how can we make our client's job as easy as possible, as kind of operationally difficult as possible, whilst keeping our risk as tight as we can. And that obviously comes with technology. There's a huge amount of investment in sort of fintech in the financial sector at the moment, and a lot of that you got kind of cutting between what's tech for the sake of tech's sake, and what is actually technology that's going to be serving customer and making a huge difference. And I think secondly, in terms of innovation, just are there any new products that can come available that possibly haven't? It's been a fairly sort of stagnant industry in terms of bringing out new products over the last few decades or so. The last few years, we've seen the emergence of revenue-based funding, which I'm sure Dominika and Alex might have come across, but is sort of leveraging the direct to consumer sales, so the Shopify sales, the Amazon sales, and it's a really interesting side of the industry. So I think that the coming years with something like that remains to be seen, whether it'll become more mainstream, whether the banks will sort of follow suit and add it to their product portfolio.
No, thank you. That's interesting, that revenue-based lending kind of model then, yeah, and see if that does kind of progress. Tom, just interested to get your kind of insight into the equity system and ecosystem in the next kind of 12 to 24 months.
Yeah, I mean, I don't think there's as much innovation happening in the equity space. I think sort of broadly, it could be quite a challenging period to raise equity. I think perversely, in a challenging environment, you're seeing more businesses kind of pivot to think about profitability earlier in their journey, and in a sense, that should help them raise debt. But I think on the equity side, there's definitely been a bit of a cool down in terms of sort of VC interest. I haven't seen it yet on the angel crowdfunding side, but that may come through. But there should be, in my opinion, more innovation on the equity side for sure. I mean, when I set up Redrice 4 years ago, I spent a lot of time trying to come up with different, interesting, appealing fund structures that weren't the classic sort of 5-year investment period, 5-year period of trying to get capital back. But it's increasingly difficult. And I think some of it needs to be led by the investors in funds. They need to be more willing to accept new fund models. So hopefully that will happen over the next couple of years.
No, thanks, Tom. And Alex, Dominika, we'll start with Dominika, then on to Alex. Obviously, Julian mentioned, interest rates are rising, and we're hearing talk of a potential recession. I mean, what in the next kind of 12 to 24 months, what do you envisage sort of keeping you awake at night in a business context?
Was that an allusion to my son? Because he also keeps me up at night. Yeah, you know what? It's been a really challenging 2 years. Like, doing our Series A is potentially one of our last fundraisers. I think the climate has changed dramatically since the start of the pandemic. And everything Tom said about changing attitudes and kind of less risk in VC, I'm definitely seeing, and I'm seeing it a lot from my fellow co-founders as well. We're not actively fundraising at the moment, but we know a lot of people that are and are really struggling. That traditionally, when I look at what their run rates are and their opportunities and growth levers, I would have thought, yeah, you're primed to do a good raise, and they're really, really struggling. I think the macro climate around finance, the public markets, is just having a downward trickle effect on early stage funding, and it's becoming incredibly challenging. We have done that pivot. We looked out to this year, and I just felt really nervous about the position that we were in as a loss-making business and our opportunities to continue to receive equity fundraising, and also my own dilution that I had suffered. So we've done that pivot, and we're now break even, small profit. And I think that a lot of businesses are making that pivot because the kind of high growth, high loss business model that was absolutely being well received 3 years ago is no longer that appealing. And actually the cost, particularly around D2C, of rising customer acquisition, but also in retail, the challenges of making those large big box retailers work. And a lot of those brands that went out, including myself, and got good venture deals off the back of huge scale distribution, we're now seeing that that's actually really challenging to execute. And those VCs that backed businesses like mine, and not to say that we haven't been successful, we have, but it's definitely been more challenging than we had anticipated, and probably our investors had anticipated. Now businesses that are coming through that have the same story, those investors, a lot of them have been quite burned. So they're like, no, actually, it doesn't matter if you've got full chain Sephora, Target in the US. I'm talking specifically about beauty. There's a lot more cautiousness and aversion to that, and they want to see sell through rather than selling. again, sorry, I'm speaking like very business, beauty specific terminology here, but you can't just go in now with a massive growth plan with no like data to back it up, and high losses just aren't being received well, because yeah, you just don't know when your next fundraise is going to be and whether it's going to be successful. And if it's unsuccessful, you're out of business. And unfortunately, again, over the last 18 months, I've seen a lot of our peer brands who have done raises alongside us and raised similar amounts of capital go for their next fundraise, been unsuccessful, and unfortunately had to close up shop. And that for me would just be an absolute worst case scenario. I'd rather sacrifice on my top line growth than even contemplate having to shut doors. So we've just had a complete mindset pivot over the past 6 to 9 months, because the challenges of the pandemic continue to have impact on venture capital funding and early stage funding now, and it's getting worse. So I would definitely be looking at debt. If you are a break-even profitable business, it's much easier to secure debt. And again, perhaps doing a smaller equity fundraise led by angels if you're very, very early stage, supplementing that with crowdfunding, and then, again, going to someone like Growth Lending or some of the other alternative lending partners to really supplement that round with debt would be, a huge piece of advice from me, because it's getting tough out there. And just because you've raised a seed doesn't mean you're going to go on to raise a Series A or a Series B. It's really competitive and really challenging to raise finance at this point, no matter how long you've been in market, I would say.
No, thanks, Dominika.
Sorry, that's not very positive.
No.
I'm just, I'm at the forefront of this stuff, so I just want to be honest, rather than say it's really easy to go out and raise capital right now.
No, it's best to be honest. And on that point, Alex, Dominika's mentioned some of her concerns, with the kind of the backdrop of the recession, interest rates, inflation. Are you concerned, or do you have concerns, and what do you see as the challenges that you may face?
In times like this, I think when the tide goes out, you can see who's swimming naked, and you're able to see businesses that have been operating in times that are pretty favorable and haven't got very good business plans. And so in times of financial insecurity, cash is king, and making sure that you've got a healthy balance sheet that is not over leveraged is super important. And any money that you do get in, maybe just get a little bit more in just in case, and not be too cute with the quantity that you're trying to raise. I think Dominika went through some really good points. I think perhaps looking at from a positive perspective, it's also a very good opportunity to make sure that you can thrive through adverse times, because through times of recession, the best businesses will be able to succeed and be able to take advantage of businesses that did not pass through. So if you're well prepared, you've got enough cash, you've got a good business plan, this is a great time to take advantage of the shifting sands.
No, thanks, Alex. I really like the tide analogy there, so I'll have to remember that one. That has neatly taken us on to our kind of 45 minutes. We just had one final point. If we want to just give a brief bit of advice to everyone who's watching, obviously in the context of what you do. Julian, if we just want to have a final word and a bit of advice for our viewers to go away with.
Yeah, absolutely. So I think advice for an early stage brand raising debt finance, as Dom mentioned earlier, if Dom's having a conversation with myself or a similar provider, we're not necessarily looking for a graph that's showing a sort of crazy steep growth trajectory. It sort of sounds boring, but we're looking for more sort of trust in the numbers, whether that's a prepared, organized, impressive management team. The historic numbers all have to add up. If we have sort of a lack of trust or queries around the sort of the truth of the numbers looking backwards, it's never a good sign. And equally, looking forwards, the forecast has to be backed by kind of realistic assumptions. If there's just a kind of crazy growth trajectory, but without any meaningful sort of stats or evidence backing it up, it doesn't mean a huge amount to kind of build up our confidence in the numbers and the targets that they've set. And secondly, I think just remember it's a two-way conversation. So do your homework. You don't have to jump in bed with the first finance company you meet and compare the costs, compare the service, and speak to other industry peers on and gain references on the lenders out there.
No, thanks, Gene. Some good advice. And Tom, just your kind of final word to anyone watching who may be looking to kind of grow and engage with the VC.
Yeah, I'd just say take note of Dominika's resilience and Alex's ingenuity. I think it's stay very positive. I think if you're going to be raising equity, if you think you might need it in 12 months, start now, because it may get harder. Who knows? I think really think about the type of investors, the VCs you're talking to, because I think it's in tough times that investors define whether they truly are founder friendly or not. I think there can be bad behavior. So I think do your homework on those institutions to make sure they behave in the right way. And otherwise just stay lean as a business. Think about reducing your sort of path to profitability. Get the team right. Get the team really strong and motivated, because I think that mistakes get more costly in these type of environments. So I think having a really strong team around you as well will be hugely beneficial. That's it. Yeah.
No, thanks, Tom. And Dominika, Alex, we'll just take a very brief final word from you both. You've been described as resilient and ingenious. So, build on from that. Dominika.
Yeah, I mean, there is also never a better time to be a founder and start a business. So I think if you've got a great idea and you genuinely believe that it offers something that's not available already in the market and you can see a path to success, then definitely go for it and feel confident about that. And good businesses, as Alex, as Tom have said, will always raise money and be able to see through tough times. So just really interrogate that business plan, keep your costs low, don't overinvest in OPEX that takes a while to get rid of, like team. And yeah, just, if you can get through this point, be successful in this point, then the light at the end of the tunnel will be that more, a nice feeling to get to.
No, brilliant. Thanks, Dominic. And Alex, please.
I'll make sure I put the ingenious tag on my LinkedIn profile later.
I know, I want that one. Resilience isn't as sexy, is it?
I'm in a generous mood to show it around. You said to be short and sweet. Two things from me: making sure you've got really excellent solicitors and fantastic accountants is fundamental. So from the financial side, making sure that you know exactly where you are and where you're trying to get to with well thought out models is key. Get really good finances and accountants. Second thing, get really good solicitors. Do not shy away from cutting costs with good lawyers. They're bloody expensive, but they're well worth it. And it can mean that you're not taken advantage of from skilled investors when you've got good solicitors on your side. So those two things I think are pretty crucial.
No, thanks, Alex. Some good advice there. Lawyers and accountants, certainly, if you get good ones, but will help you on your journey. So I just want to say thank you to our viewers. Thank you to Dominika, Tom, Julian and Alex for your time and insight today. It was really, really interesting and lots of takeaways. This will now go on our website so you can watch it again if you want, and will also become a feature. And do go check out Business Leader for our other events and features. Thank you.